Hello everybody, my name is Mark. Welcome to another video in my Profitable Investor video series. And in this video, I'm going to talk about 7 reasons why you want to invest in stock options. And so without further ado, let's jump right in and let's talk about 7 reasons. So reason number 1, leverage. I really like this quote by this guy, Robert Kiyosaki, author of Rich Dad, Poor Dad. Financial leverage is the advantage the rich have over the poor and the middle class. And like it or not, that is the truth. And you should learn how to use the power of leverage in your financial life and get rich like the other rich people. So here I pulled up the definition of leverage compared to the definition of margin. Margin and leverage are 2 different things, and this is a la Investopedia.com. So leverage refers to the act of taking on debt, such as when you buy a car. Okay, you're not necessarily borrowing money to buy the car, but you are taking on debt and you are using borrowed money as per the contract to buy that car. Now, margin is the other way around. That's where you actually are borrowing the money and then using that money to invest in whatever you invest in. Okay, so if I were to put it in my own words, margin is when the capital you're using to invest with is greater than the capital that you have to start with to invest with. Leverage is when the value of your investment is greater than the capital you are using to invest with, such as in the case of a car. Maybe you pay a $2,000 down payment for a $15,000 car. Now, you're not necessarily borrowing money to pay that $2,000 down payment, but the value of your car is greater than the $2,000 you're using to buy the car. And that is definitely the case with stock options. Stock options are contracts to buy or sell 100 shares of stock per contract. Call options give you the right to buy, and put options give you the right to sell. Calls and puts, they cost very little money compared to actually buying the 100 shares of stock, so that the value of your investment is much greater, and I mean that with capital letters, much greater than the capital you're using to invest with. And that leads to my next point. Stock options cost very little money to buy and sell. Okay, some stock options cost as little as a few dollars per contract. Here's an example of a stock. This is McDonald's stock, and you can see at the top under last their closing price is $145.21 a share, and I highlighted a $148 call option there at the lower left hand corner, and it costs all of $10. So you can buy one contract to buy 100 shares of McDonald's at $148. Now I highlighted how long is the contract good for, and that's 7 days. So in order to make money, the value of McDonald's would have to go above $148 in the next 7 days. So there is a risk, and you might lose $10, but it's better than spending, what, 145 times 100, 14,500 and whatever dollars. For my money, it's much better to spend $10 and maybe I'll lose $10, right? Or if you thought McDonald's was going to go down, I highlighted the $143 put option, and that will cost you all of $25. So you can see how little money it costs to buy and sell these stock options. And that leads to my next point. Stock options are very liquid, and time is money. You can lose your money and you can get it back, but once your time is gone, you can't get that back. Once it's gone, it's gone. It can take several months to buy or sell a house. You have to find a real estate broker, list the house on the MLS in the open market, and then wait however long it takes to find a buyer, get the house appraised, escrow, closing costs, etc. But with stock options, that can take as little as a few seconds. Okay, millions of people trade these stock options every single day. Getting in and out of these stock options investments is easy as clicking your mouse. You just set up an account with an online broker. Like I use Ameritrade, but Scottrade is good, E-Trade is good, Interactive Brokers are good. You can Google search all the different brokers there are, and then you could spend maybe 5-10 minutes a day keeping track of your investment. You can set your own schedule, be your own boss, etc. and so forth. And it's fast and it's easy. That's my next point. Okay. Here's McDonald's stock. Let's say that you wanted to buy a stock option of McDonald's. Okay, so you put in the symbol. I highlighted the symbol part at the upper right, and then I highlighted the part you click if you wanted to buy an option. So you click that option chain, and then this comes up. And then I highlighted the different kinds of options you can get. You can get some short-term options there at the top. The upper ones are 14 days or 21 days, and then further down, I put down September 15th. Today is May the 12th, 2017. So that's what, about 4 months from now, 126 days, or you can go further out, and you click on one of those, and then this comes up. Okay, and there on the left side, I highlighted the calls and I highlighted the puts, and you can pick any of those strike prices. So whichever option you want to, if you think that McDonald's is going to go up, you pick a call option. If you think it's going to go down, you pick a put option. You click on one of those options, and then this comes up. Okay, and there I highlighted the parts that you want to click on. Under action, I clicked buy to open because you'd open a new contract, and then I put in the number of contracts one. Over there on the right, you put in the price, and then on the far right, I highlighted review order. Click on the review order, and this is a little confirmation receipt. You make sure everything looks good. Buy to open one contract, McDonald's, June 16, 2017, etc. Estimated total cost $38, and then I circled where you click to place the order. So that's how easy it is. Fast and easy. It's really, really cool. So next one is you can profit during a recession. And again, I like Warren Buffett a lot. You know, I like rich people. I would love to be rich like him someday. And so I pay attention to what people like Warren Buffett say. And rich people like Warren Buffett look at bear markets and recessions as opportunities. They don't look at these things as bad things. They see them as buying opportunities. But with stock options, you can buy a put option, and that gives you the right to sell stock at set prices as per the put option contract. Okay, so that when the value of the stock goes down, the value of the put option goes up. So here's an example of a stock, JCPenney, and again, today is May the 12th, 2017. It went down 13.99%. So if you would have bought the stock, you would have got killed, right? You would have lost some money. But look what would have happened had you have bought some stock options. Okay, and I highlighted the $4 put option, and then you can see you would have made a 70% return on your money. And then I highlighted the $5 put option, and you would have made a 78% return. The $6 put option is a 53% return. The $7 put option, 21.98% return. I would take any of those returns. Those returns are great, you know. So put options is a wonderful thing to do during recessions, or if there's a stock that's doing badly, you can make profit off of that. Okay, so the sixth reason why stock options are great is because you can protect your investments. Okay, buying put options and selling call options to finance those put options make it possible to invest in hundreds of different stocks safely. Okay, so here's an example right here. Apple, trading at $156.10 per share. Again, today is May the 12th, 2017. Okay. Now, here's an example of something you could do. You could, let's say you had some money and you bought a couple hundred shares. That would cost you 30 grand, more than 30 grand, right? And so what you might consider doing is buying 2 put options at the $145 strike price. I highlighted that, and then on the left, I highlighted the time frame, and I picked the 399-day time frame. So for the next 399 days, that's over a year, you have the right to sell Apple stock at $145 a share, and that's going to cost you $970, right? But let me go back and explain something here, okay? Apple stock, as of today, is trading $156 a share. So if Apple went up $10 a share, that would pay for the $9.70 you're spending for that protection. And then what you would do is you would sell a call option, and I highlighted the call option that might be good to sell. You pick $170 strike price. That's a $14 stock appreciation. So you would pay for your put options and then some. I highlighted the expiration date, which is only 70 days, and you could see you would get a credit of $90. So you do that every single month, month after month, maybe 2 months or 3 months. Eventually, you're going to pay off that put option, whether Apple stock goes up or whether you just make it in premium. Or if something goes wrong and Apple goes down, well, then you'll make a profit on your put option that you bought. So it's a great way to protect your investments. It's one of the primary investment strategies that I use for my own money. So protect your investments. And finally, the seventh reason why stock options are great is because it helps you become an active investor. Those who do not manage their own money, you will always work for those who do. Okay. Now, the benefits of being an active investor, number one, you get to learn what's going on in the world. You study the market, you read the news, maybe you turn on the TV, watch NBC. However you choose to keep an eye on your investment. And two, there's no management fees. You don't have to worry about financial advisors or getting ripped off. And you are in control of your own financial destiny. So it's really a wonderful thing. So that's it, ladies and gentlemen. 7 reasons to invest in stock options. Number 1, leverage. 2, little money. 3, they're very liquid, fast and easy. You can make money during a bear market. Number 6, you can protect your investments, invest in any stock you want safely, and you can become an active investor. So that's it, ladies and gentlemen. I hope you enjoyed this video. Thank you for watching, and I will see you in the next one.